In the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risk and seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only and is not intended to be a personal recommendation or construed as advice. All traders must understand that there is a high element of randomness to the markets, and therefore they will experience both winning and losing trades whilst following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. And this is one of the most important reasons why every trader needs to have a trading plan, not a strategy, but a plan. So that when this randomness of the market happens, and when you're using a strategy and you're trying to figure out why one guy's making a ton of money at it and you're not doing right and you're losing your account, it's because you don't have a plan. He's got a plan. That your plan needs to cover everything and anything you do so that your emotions don't take control when you go to trade the markets. Now, tonight's class is being recorded, and if you want to see a recorded copy of tonight's class, just use the same link you used for tonight's class in about 24 hours, and you can watch this class again. Now, tonight, we're going to be talking about building a trading plan, not building a strategy, not deciding how to make trading or open positions, but how to make solid trading decisions and how to incorporate this into your overall plan. Now, in order to become a successful trader, you need to develop a written trading plan. And this is where most people fail. They want to blame it on everybody and everything but themselves. But basically, your trading plan is your Bible. And if you don't stop and sit down and do this, there is nobody else that you can blame for you not being successful. Now, there is no such thing as an ultimate trading plan. You're not going to go to the internet and search one out and just copy somebody else's. Not going to happen. Because this is a trading plan that you develop based on you, your goals, your work schedule, your time schedule, your personality. Okay. So no two traders have the same trading plan. Now, you can start out with the same elements, but every trader has a different trading style, strategy, risk tolerance, and market experience. And it's always better to develop one's personalized trading plan and modify it as your experience grows. Because as you become more experienced in the market, you know more. And if you keep putting these notes into your plan will develop. You don't have to start tonight after class and write this big 20-page plan or build up all of these Excel worksheets and everything else. No, you start off with a little bit of guidance. And when you have time and when you see something else, you add it into your trading plan. Because your trading plan should be thought as a template for trading the markets, not for making a particular trade. Perhaps a better way to describe a trading plan is that it's a checklist. This checklist will contain each aspect of making a trade in a logical step-by-step sequence. Now, don't misunderstand me. You don't have to be that methodical. You don't have to check every box. You know, I'm discombobulated to say the least. I mean, I have notes and everything all over my desk. I have sticky notes on my window next to my desk that have been up there for years. You know, not all of us are OCD organized, okay? But we all have some sort of way that we function in society and function every day. And that's why our trading plan has to fit who we are. Like I said, the same elements can make up this plan, but you know, you don't want some plan that you're going to ignore entirely because it just doesn't fit the way you do business. Now, for me, I like Excel. I'm comfortable, so I do most of my trading plan through Excel. And every trade I do is laid in and laid out in my Excel spreadsheets. Every analysis I do. And what happens now is by titling each spreadsheet correctly and having each asset and each page, okay, I want to see, and this is one of the reasons you also limit the assets you trade. Because otherwise you could have this plan, and the plan is just a start. Because a big part of this plan is how you deal with each trade, what the results were of each trade, how you analyze those trades to see if they're working for you, okay? And how something happened. You could have made a ton of money on the euro and lost a ton of money on gold. Maybe down the road, you might say, you know what, I should stay away from gold because I don't do too well. But psychologically, you think you did really well because you had that one big successful trade somewhere that you keep remembering. Okay? But when you do your analysis, you see, I made lots of little trades in the euro. I made lots of money, lots and lots of trades, but made lots of money. But gold, I don't do so well in. Or I did very well in gold when I saw this exact pattern happen 3 years ago. Not pennants and flags, not somebody else's writing. When I saw this happen and this happened and this happened, I did very well on my trade in gold. So when you go see something similar happening in gold today, you can go back and see what you did, how you did it, where you, how much volatility, where you set your stop losses, how much money you wanted to risk, what was your risk reward ratio that you allowed yourself in that trade. So your trading plan ultimately ends up with an analysis of every trade. Now, it will include what your trading strategies you're going to trade, but not what trading strategy you're going to use for this particular trade. What trading strategies you will use overall. Okay. In flat markets, maybe I'll say I'll use MACD, and in volatile markets, I'll use RSI and stochastics. Maybe I'll use support and resistance, or I'll combine that with Fibonacci levels. These are how I'm going to analyze the market. Also, what assets you're going to trade. So many people jumped in the Bitcoin market because it was in all the news headlines, but they never did any proper analysis. They never added into their trading plan. They never got to understand cryptocurrencies. They're just reading, Bitcoin's rallying, Bitcoin's heading to 20,000. Let me trade. But you see, if it wasn't in your trading plan, you wouldn't trade it, because guess what? You have rules about adding another asset into your trading plan. You also have your daily routines and what they will be. Because not all of us live in the markets and can trade 5 days a week. A lot of us have regular jobs. A lot of us have families. Now, the thing is, you don't want to say, okay, well, you know what? When the kids are all playing soccer, the wife's off picking them up, I'm going to get online and trade a couple hours. That's a very unrealistic, unsuccessful thing to do. Now, you might say, when you get those couple hours, I'm going to do some analysis. I'm going to fill in my trading plan. But you should always decide, and it should be built in your trading plan. I'm only going to trade the markets on Mondays and Thursdays, and I'm only going to trade between 6 and 9 p.m. Okay, so if I'm not free between those hours, I'm not going to trade, because the markets have personalities also. They do different things at different times. Different assets react at different times. You can't be chasing the market. You can't run in the house, kiss the wife, kiss the kids, send them off to bed, and jump on the computer and start trading. It's just not a successful way. So the question is, where do you start? Well, the first thing you have to think of is think of your trading plan as a business plan, because you're going into business. Now, if you were going to open a retail store in the mall and you needed to get inventory, you needed to get cash flow, you needed to buy a cash register, you needed to get racks and display items, and you had to hire people. Guess what? And you need to go to the bank and get a loan. How do you judge? How do you gauge whether you're being successful? How would you know whether you should be buying lots of medium blouses and only small and large blouses and no smalls? or the smalls sell double the large. Because even though the salesman might instruct you that normally you buy a package of 24 of this and it comes with 6 of that size, 6 of this size, 6 of that size, because they sell kind of evenly. Well, it happens to be that the mall in the city that you're living has, you're in Southern California on the beach where all the girls, or a higher percentage, are very, very thin. So you would be doing better off having more smalls. And we're not talking about being prejudiced towards one another. This is understanding your demographics. If you're in the Midwest, okay, maybe you need more mediums. Or maybe in the Midwest, light blue or yellow sells better than pink. You need to know this. This is the same thing for trading the markets. So the easiest way to begin your trading plan is to start with your strategies. Because this is what every beginning trader, every experience already kind of has. They already want to start with, reading, they already kind of know what they're going to do. I'm going to use support and resistance. I'm going to use volume. I'm going to use Fibonacci's. This is what I'm going to do. You also know right off the top of the bat what assets you're going to start trading. You may change down the road. I traded for years only agriculturals. I don't go near agriculturals anymore. So you change, okay? But you need a starting point. So if you're trading price action setups or off key structural levels or structured trading or advanced patterns, then you should put this in first. You need a starting point. This is where you can start from. Now, this will act as a blueprint for what you need to do each time you interact with the markets. Okay. Now, hopefully, whatever strategies you're using, you've back-tested them, you've defined them, you've worked them down. You understand, because too many traders trade too loosely and trade too many trades. And we're going to get on to talk about that in a minute and how that's built into your trading plan. Okay. In addition to your strategies, you need to put in your risk tolerance and your money management rules. Okay. But you have to define these. Most traders have never actually defined what their risk tolerance is, what their money management rules, what their profit loss ratios have to be per trade. Like, I don't ever make a trade that I don't have a 3-to-1 profit to loss ratio. Never. Even if the trade is beautiful, I don't make it. Okay. I only tie up not in a trade, but only have so much of my working capital in the markets at one time. Because maybe I got a trade earlier today on the pound euro, and maybe now I'm trading the pound US dollar, and something opens up, I see interesting in the USD JPY. But the fact is, I got too much of my capital in the markets. I have money in my account, but I might only limit myself to never have more than 20% of my capital in the markets at any given time. So guess what? I can't make that trade because I either have to close out an existing trade, or I can't make it because my rules say I can't do it. And this stops me from being foolish. And we'll come up to some other rules about that in a minute. But when you have written strategies, you'll find your risk tolerance and money management is like having a market blueprint. This blueprint is essential for developing the discipline that it will lead you on the road to success. Because I might look at an asset and say, okay, here's the euro US dollar. It's moving pretty active today. We're getting ready for the ECB meeting on Thursday. So we're getting some volatility coming from us. So I need to put my stop loss at 121.50, which is 65 points from where it's currently trading. Okay. Well, how much can I risk in a trade to cover my risk tolerance? Not, because I know I need to have a 65-point spread between my buy and my stop loss. Well, that starts to dictate, number one, if I need to put my risk there, what should my reward be? And maybe that reward is too high. Then when I factor in my money management, maybe that 65-point spread from the buy to the stop loss is too large for my money management. Okay, so guess what? That trade has got thrown out the door. And it's not a matter of going back and saying, look at that, I would have made money. Never. You don't ever go back at a trade you didn't make because your risk tolerance, your money management, or one of your other rules said don't make that trade. Don't you dare. Because then you're going to start adjusting your rules because you wanted to make that trade. And as your account grows, as you're more successful, you can slowly increase your risk tolerance. As your account's larger, you're adding more money to your account. So therefore, your money management allows you to make a bigger position. But don't violate your rules. So if you find yourself not following the rules in your trading plan, then you know you are deviating from your plan. So once you've started out with your strategies, the next thing you should do is state what instruments you are trading. Because that's one of the biggest problems in the marketplace. Too many traders with online trading have the availability to so many assets, and everything's computerized today, so it makes you be able to do things a lot faster. Again, when I was trading back in the early 80s, don't misunderstand me. It's not that computers didn't exist. PCs didn't exist. Software didn't exist. So we went in a broker's office and used his monitor and his computer that was in this great big air-conditioned room. But I didn't have computerized charts. I didn't have a charting service. I didn't have trade alerts. I couldn't drop my Fibonacci levels and my RSI, my MACD, see my volume right on my charts. I had to sit there and do it by hand. Not me, all of us. So we could only focus on a few assets. So computers, online trading, advanced charting, even just being able to drop support and resistance lines automatically on a chart, give us too big of an area of access. So by limiting what you're looking at, and you can take, if you like tech stocks and you want to take, Intel, eBay, or whatever else, or you might want to incorporate during earnings season, which we're in now, hey, I'll add some stocks in. But that's what I'm going to only do 4 times a year for 1 week. You could have that in your trading plan. Okay. But what are you going to trade regularly? Okay. Because you can trade the euro pound, the euro dollar, the euro Japanese yen. You could be trading so many assets that you're just making too many mistakes. You can't understand and learn them all. So by starting out when you're trading plan with what assets you'll trade, because that's also what assets you're going to analyze, you start limiting yourself down. So you need to have a routine also in your trading activities. In your pre-market phase, you write up all you were going to do from waking up to what you do before you're sitting at your trading desktop. And you think this is ridiculous. We're not talking about your personal habits. We're not talking about taking a shower. We're talking about taking a cup of coffee. Okay? We're talking about, okay, I'm available to trade, or I have my free hours that the wife's going to be with the kids on Mondays, Wednesdays, and Fridays. Okay? So this is your routine. I'm going to come home from work, we're going to have dinner with the family. They're going to do their thing, and I'm going to go in my little den, studio, office, whatever you're calling it, and I'm going to spend the next 3 hours trading. I get to do this 3 days a week. Okay, so you're starting to put your trading activities down. Unless you're going to be a full-time trader, then you need to have a full day's worth of work. But there's also things like, did you have a bad day at work? If you did, I'm not going to trade tonight. Did you have very long, exhausting meetings? I'm not going to trade tonight. Okay. Now, this will include things to look for in the market and what you want to do before you're entering a trade. Okay. So this is part of your trading list. Okay, this is your what we call pre-market phase. Then you have your post-market phase. And the post-market phase is very important. Your main activity will be record keeping of your trades. A trading journal is important because it allows you to analyze your trades and find out whether you follow your plan or not. So make sure you maintain a trading journal which has logs of all of your trades. Now, hence Excel. Now, again, computers make this easy. You don't have to sit there and list them all in, because you can go up to your account on ETX and just download all of your activity in an Excel format and keep it all going on a sheet, because that's easy stuff. But it should include your entry date, your entry price, your exit price, your stop loss, your take loss or take profit, your final notes, which are personal notes about each trade. Okay. Now, your daily routines are crucial when you're trading, if you're trading success, because based on them, we build a ritual that helps us maintain a high level of focus and state where we perform at our best levels. Now, I'll give you an example. I start my days at 5 o'clock in the morning. Now, the first thing I do is I flip on my computer, of course. Okay. I click on my charts from the night before, and I very quickly look at my assets. I'm not analyzing charts. I'm looking to see where my assets are at the moment, because I can tell you what happened overnight by quickly looking at those prices on the charts. Okay. Then I look at my economics calendar to make sure I know any major events that are going to be affecting the market during the day. So I've got some guidelines in my head, because what's going to happen is throughout the rest of the day, when I'm busy with other stuff and not trading, okay, I know I can go look at the euro US dollar, and I can basically tell you on Thursday at 11:30 what Mario Draghi said in his release, because I can see in the euro reaction what happened. But I have to know that event was scheduled, and then I have to look at it. So this is important. Your daily routine of how you're going to look at the markets and analyze, not trading decisions, just to understand what is happening. Now, your trading plan should contain a written description of what you will do in the markets. This includes things like your trading edge. Your trading edge is like your strategy. It gives you an edge up in the market, is how you will outsmart the markets. Now, I'm a price action trader. I trade more from movements in price and short-term prices, but I'm also a swing trader for stuff. I trade stocks more as a swing trader. I trade currency as a very short-term trader. Okay, so you have to decide what you want, what your edge is, what's going to make you successful. You have to, again, risk management, profit taking, and your overall goals as a trader. Now, I use a word that's really not a word. It's called stick-to-itness. And what this means is when you create this plan, and if you do it well, okay, you'll realize you spend more time doing analysis, following your plan, reading your plan, filling in the boxes you set up in your plan, doing your checklist than trading. Well, if you get to enjoy this, and see, I enjoy the analytics part. I enjoy following my trade. I enjoy the search for a good trade. Now, with online markets, it gives us the ability to place way too many trades too fast, too often. So you can curtail this. You can filter things out with your trading plan, get emotions out of it. And if you spend more time with your trading plan, your analysis, your history, and your analytics, you'll find you'll make a lot less trades. You'll spend the same amount of hours. Hopefully you'll do better in each one of your trades, and you'll start developing an overall look. Now, so a key part that you're going to add into your, once you've had the easy stuff, you've added in your risk management, your money management, because you know what it is. You've added in your strategies. You've started with a list of assets. We're not saying you have to define it and finalize it and make it finite at the beginning. You start with a list. The next part that's very important is how many trades will you use to evaluate your performance? And how often will you stop everything to evaluate your performance? So in most businesses, what do you think our quarterly earnings are? If Google has to stop every quarter and put everything down on paper and release it to the public, don't you think that you should have to evaluate how you're doing? Because unfortunately, you could think you're doing quite well and not realize that you aren't, because your portfolio could be up, but you're making too many bad trades and don't realize it. You might have a key winning strategy that's doing great. If you, again, we'll go back to the euro and gold. If every time you traded the euro, you did well, but you did small profits, but you did quite well, and you're out there trading Google, Alphabet, Intel, Microsoft, you're trading some oil now and then, and when you go back and analyze it all, see, if you would have stopped all of that other stuff, you would have been in the same position you are right now if you only traded the euro. Well, that's a key piece of information, because you know what? It tells you, number one, whatever you're doing for the euro, you're doing very well. Let's see how we can apply that elsewhere. But let's get rid of all that peripheral junk. So I personally say every 10 trades, you completely stop and you do not go back to the market until you do a full analysis of those 10 trades. So for me, that number is 10 trades. This applies to both my swing trading and my day trading activity. On average, it will take me approximately 3 months to place 10 swing trades, or about 4 days to place 10 day trades. Okay. So that means about once a week, I'm stopping and evaluating everything before I can move on. Now, I only mention this because the time element, as you can see, how long it takes me to place the number of trades based on the trading style. You have to, again, this is personal, you have to decide where it is. You know, you could say, I'll do it every 30 days. But sometimes 30 days is too late, because you can turn a winning portfolio into a losing portfolio, because sometimes the markets change the way they're moving, not you. The markets go into safe haven mode. They go into stress mode. And what happens is your strategies that were working and doing quite well for you aren't working right now. And if you don't understand that and you don't analyze it, guess what? You'll be making too many bad trades until something in your head goes ding, 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 ding. So what is the number of trades you will use when evaluating your trading activity? Now, also, keep it simple. Don't get it overcomplicated. Okay, how many trades did you make? That a successful trade doesn't mean it made you profit. You could have had losing trades that were very good, solid trades. Okay, so this is what you need to know. Oh, I made the trade in the euro US dollar. Something crazy happened in the markets because, you know, Kim in North Korea shot off another missile, and the market's tanked. It wasn't my fault. I could have, but because I placed my stop loss completely correctly, I got out of that trade with a very small loss. Well, guess what? That's a successful trade. Again, we mentioned earlier how much at any given time you will have in the markets. Okay. Now, for me, it's what time of day you're willing to trade. Because like I said, the markets have different personalities at different times. Okay. There's different economic events. Like if you notice, after you pass 10 o'clock US time, especially if you're trading currencies, so all the economics data is out, the markets get very dull. There's not that much activity. Okay. They're very busy before that. They're very busy between the Asian and the European markets overflow. Then there's hours during the European day that it's kind of slow. So just decide, you know what? These are the only hours. If I don't see a trade that fits all of my plans between these hours, guess what? I'm going to go off and do other stuff. So similar to times a day you trade, keep your trading edge down to 1 or 2 steps. Again, you don't want overcomplicated strategies. Because remember, price action is ultimately what controls the markets. Okay. So maybe you want early range breakouts. Maybe you're a high volume trader. Maybe you want to put together support and resistance and volume. Okay. Keep them simple. Okay. And you want to develop some type of plan that will give you market alerts. Okay. Whether you want to use MACD crossovers to give you alerts, because you can't trade and watch all the assets. So you could set it up so your computer automatically gives you a price alert, or what level you want to be alerted from your system. ETX will send you out alerts all you want. You just set them up and they'll send them out to you. Or when would you like to set up what limit orders you want to enter? Okay. So remember, you should have short-term and long-term goals and get to work, stick to itness, and then reach that goal. Because a goal without a plan is just kind of a wish. Now, whichever trading strategy you want to work, and test it and back test it and refine it. Where you're going to place your stop losses, how you're going to determine where your stop loss. But then we go to something more important. It's analyzing your stop loss. If you keep getting stopped out of the markets, okay, that means either you're trading assets, you're putting your risk management reward ratio, your risk reward ratio are too tight. So therefore you're not getting your stop loss too low, or whatever measure to measure the volatility, you're not doing correctly. Because you should very rarely be stopped out of a market. Only when the market turns against you. But simple movement and volatility of the market shouldn't be stopping you out. You should add in when to exit. You know, there's an old saying out there, let your winners run. Well, you know, today, because there's trailing stop losses and other things, if you understand how to use the order entry system, right, you can successfully do this. But then, okay, if you're going to use trailing stop losses, how many pips do I want to put it at? Where do I want to place it? Okay. This is defined in your overall trading plan. Now, for some reason, traders have fooled themselves into thinking that successful trading only boils down to the latest algorithm or technical indicator. This couldn't be the furthest thing from the truth. When you're trading, you may forget that there are human beings on the other end of a buy-sell transaction. This is a head-to-head competition to see who is right, the bulls or the bears. Part of the game of trading is not revealing your hand. So, always make sure you work smart. The success factor, my friend, begins and ends with a winning attitude. Think about it. When you see your stock have a short hiccup in a current trend, is your first reaction to sell and lock in profits? Or do you move your stop up so quickly that you're basically begging the market maker to trigger your order? A winning trader will see the same price movement as you. However, he or she will not interpret the information negatively. Their ability to sit through these corrections does not mean that they have a lack of money management principle. It just means that they believe in the markets will go in their favor as long as the correction or counter moves do not damage the overall trend. Okay. Again, how much money you can risk in the overall market and how much money you will risk, or how much of your capital you will risk per trade. And that should be written in stone. Now, you're all going to think I'm crazy, but the next is when to take breaks. Now, everybody says, well, you know what? It's 4th of July holiday, or it's Independence Day, or it's bank holiday, or it's spring bank holiday, or it's Christmas. Okay, so I had a break, and I'm going taking the family on vacation for 2 weeks, so I have my vacation. This is not taking a break from the markets. Part of the discipline in the markets is who's in control. Is the platform you're trading in control, or are you in control? You demonstrate your control by saying, after every 100 trades, I'm going to take one whole day off, not from work. I'm not going on a holiday. I'm just not turning on my computer. I'm not looking to markets, and I'm not going to do any trading. It puts you in control and puts you back into discipline. And just remember, keep calm, take a break. Now, again, it's going to sound like crazy. But for me, if I lose 2% of my trading capital at any point in the day, I don't care about what is happening. I don't care that I have some good trades over here, some bad trades. I close out all of my positions and walk away. I just say, you know what? Today is not my day. I don't get mad. I don't get aggravated. See, today is not my day. Close out everything and walk away. But on the other hand, if I've had a really good day and I've had a couple exceptionally good trades, I close out every trade I have open, put my money in my account, and I'm happy, and I close down my computer. and walk away. Why? If you had a really good day, you made a lot of money on the first 2 trades in the morning, you tend to get sloppy. And this will stop you from getting sloppy. So on the screen, I put a very basic trading plan. It's too basic. It's one of the ones I found online, but it's way too basic. It's too complicated. Like I said, start out somewhere. Get a starting point. Start writing it down, because what you're trying to do is take your emotion out of trading and also take the mistakes out of trading. So easy. It's so easy to overlook an economic event or forget to put a stop loss. Forget to check in assets. Forget. So if it's down and you're checking boxes on a checklist, you find that things like this happen less. So start out easy. Don't push, don't scare yourself away. Do it on a spreadsheet. Do it on a Word document. Do it however it's comfortable for you. I mean, I still have index cards all over my desk, boxes and boxes. Because back in the old days, we wrote it by hand, and we wrote every trade on index cards. And I have a box for the euro, I have a box for the dollar, I have a box for pork bellies, a box for cattle, I used to trade tons of orange juice. And everything that ever happened with me in orange juice, for all the trades I made for all those years, in that box. Now, I don't trade anymore, but if I wanted to go back and trade orange juice, I would go back and look at those trades and see what was happening. I'd see when the port of Brazil got closed down for a strike, how much did orange juice rally? Because I need to predict when the same thing happens 10 years later, what can I see in the effect of orange juice? So remember, trading is a business. You don't go into business blind. You don't hope and pray. You need to know when to order inventory. You need to know when to put stock in. You need to know how much change to keep in your cash register. You need at the end of the night to balance out your cash drawer. You need to know when payroll is gonna. You need to know how much you can pay the part-time girls working when you want to go out. Okay. You need to know what the mall hours are, what you're required. You need to know what your insurance costs you. You might find out, hey, every time I sell that blouse at $9.99, I'm losing $5. So you wouldn't go into business without a business plan. And the business plan covers everything from the activity of your day-to-day operations, your advertising budget, the footfalls, how many people you expect to walk in the door to your store. Not how many you're going to buy. You need to know, did 50 people walk in the store today? I only sold one. Or did only one person walk in that store and I only sold that one? Okay. All of those are important, just like in trading. So on that note, I'll say goodbye to everybody. We have a very interesting May schedule coming up. We have a new webinar on the 1st of May on cryptocurrency, because now we have 5 cryptocurrencies you can trade on the platform. And we'll be going over how to understand the differences and what's the difference between Ethereum and Ripple and Litecoin, and how the prices move between them, and why you might want to buy or invest in a Bitcoin or Ethereum instead of Bitcoin, or Ripple instead. And we'll go over that step by step on May the 1st. We have a couple other new webinars. The May calendar is on the website. So thank you very much for joining us. Thank you for supporting ETX, and have a great evening. And remember, you can see a recorded version of this class in about 24 hours by using the same link used for tonight's class. Good night now. We'll see you tomorrow night, I hope.